Good morning, guys. Today we're going to continue on our series looking at the central banks and monetary policy. Today we're going to be looking at potential solutions or at least some different school of thoughts around economics and how we can implement those in our current system to create a better standard of living, a better civilization, all these sorts of things. We previously discussed the problem, which was that inflation or the price of goods and services is outpacing our wages, therefore, the gap is ever increasing, leading to a lower standard of living and purchasing power gradually declining. We talked about how this happens with the central banks printing money targeting 2 to 3%, but prices rising at 3, 4, 5%, and asset prices rising at 10% per year, and wages rising at 1 to 2 to 3%. Obviously, the gap increasing, purchasing power decreasing, incomes not rising as fast as prices, leading to a lower standard of living. Today, we're going to jump into some different school of thought around Austrian economics, the monetarist point of view, and also the classical school of economics, and compare that to today's school of thought, which is more sort of Keynesian economics. So, as I just mentioned, guys, the current school of thought is largely around Keynesian economics, which is named after John Maynard Keynes, who sort of rose to prominence around the Great Depression and the need, I suppose, for central planning, central intervention into sort of financial crises that happen, which is sort of a natural part of economics, I suppose. Now, more about Keynesian school of thought. What do they believe in? They believe in a lot of central planning, so people at the top are kind of monitoring and injecting what they believe is necessary for markets to function properly. This involves like artificially moving interest rates up and down through central planners like a central bank. It involves artificially determining the money supply, so they determine how much liquidity, how much money is inserted or taken out of the economy from a central planner, like a top-down view of things. The Keynesian school of thought also prioritizes economic demand over economic supply. So you often hear when there's a financial crisis, we need to go out and spend, spend, spend. We need to print money, inject it into the economy through government programs or government bailouts, and spend, spend, spend to artificially stimulate the economy through economic demand, which is through people purchasing things, not increase the supply of goods through production of goods and services. Now we're going to move on and shift the conversation forward, and I'm just going to add in some different schools of economics to the conversation that we may be able to pull some ideas from to implement into our current system that may be able to make things better, i.e., like our purchasing power increasing over time, wages rising faster than inflation, all these sorts of things. So the first school I'm going to touch on is the Austrian school of economics. Now, the Austrian school of economics is very different to the Keynesian school of economics. What do they believe in? The Austrian school of economics, one, they don't believe in a central bank, and they also believe in having a commodity-backed money supply. What does that mean? So they believe that for every dollar you have, that dollar should be backed by something, normally something like gold or silver. Sometimes in history it can mean like $1 can be backed by like a seashell or a cow or something like that. It actually has value to it. So each dollar you have is traded with something, and it actually is backed by something, unlike our current economic model where currency is fiat, it is fake, it is just the only thing backing it is our belief in it, but it actually has no real value to it. The Austrian school of economics also doesn't believe in having a central bank. They just believe in having multiple, either private or sometimes sort of multiple national banks sort of spread out around the country, but they don't believe in a centralized central bank that determines interest rates. They believe in multiple banks that create their own money through giving out loans, which is backed by something, i.e., gold or silver, a shell, pebbles, something of value, and that money which is backed is loaned out to people. That creates the money supply, and more demand for money means that people will take out more money, or there'll be more money injected into the economy based on market demands, not a central planner planning out how much money should be injected into the economy. The Austrian school of thought also believes that interest rates should be set by the market, not by a central planner. How would this work? For example, you may have demand for money. You want to take out a loan for a business or for personal use. You would go to the bank and say, I want to take out a loan. Based on market forces, the interest rate is going to be higher and lower. So, for example, when the economy is booming, the interest rate will be higher. That is because there's more demand for money. So there's all these people going to the bank. They want money. Well, the demand for money pushes up the price for money. You want to take out a loan, so do 10 other people. We're going to make money off this because there's so much demand for the bank loan, for my bank loan. Therefore, the interest rate will be higher when times of economic prosperity are happening. This high interest rate sort of acts as a buffer to safety. So there's almost less demand in a sense for the loan because the interest rate is higher. That acts as kind of like a stabilizing force. So not just tons of people are taking out low interest loans, which we've seen over the last sort of 10 to 15 years since the financial crisis. If the economy was worse, we were in a recession, the businesses were going broke, people were going bankrupt, then the natural rate, the natural interest rate is much lower as the demand for loans is lower, right? Because less people are spending, businesses are going bankrupt, people don't want to start up businesses, it's more risky. Therefore, the natural supply and demand interest rate, the market interest rate is lower because there's less economic demand for loans, right? And this is how interest rates will be set in a market-based set form of. To quickly summarize the Austrian School of Economics and some general ideas they believe in, they don't believe in a central bank. They believe in decentralized banks. They believe in a commodity-backed currency, not a fiat currency. They believe interest rates should be set by the market. And they also believe that the money supply, i.e., people taking out loans or the money supply being injected into the economy, should be set by the market, not a central planner. As for the Keynesian School of Economics, they believe in a central bank, they believe in a fiat currency, and they believe in interest rates and the money supply should all be set by a central planner. Now we're going to move on to the Classical School of Economics, which was founded by Adam Smith. He's known as the father of economics. What does the Classical School of Economics believe? To begin with, they believe in a stable or a backed currency, so definitely not a fiat currency, but at least something that is backed by a commodity, or at least something that's stable and that matches the productivity of a country. So, for example, if your GDP is increasing at 2 or 3%, then the currency should increase at 2 or 3% to remain stable, and the rate of inflation doesn't outpace the production of the country by a huge margin. What would that look like if your GDP was 2 or 3% and your currency was like inflating at 6, 7, 8%, then it's clearly not stable. The Classical School of Economics believes in something that is backed by a commodity or that is at least stable and matches the productivity rate of a country. They also believe in decentralized interest rates, so they believe in market forces determining the interest rates, which we discussed before, similar to Austrian economics. Now, the Classical School of Economics didn't have a particular view on central banks because at the time of the school of thought developing, central banks weren't really a thing and it was still fairly decentralized. So this is something that sort of came along in the future and wasn't really around when the Classical School of Economics was developing, but they still believe in sort of a more decentralized system where market forces determine the rate of interest, money supply, and loans and money being injected into the economy. To summarize the Classical School of Economics, they believed in a decentralized interest rates being set by market forces. They believed in a backed or at least a stable currency which rose with the rate of production or decreased with the rate of production, at least something that's backed or at least stable. And then for a central bank, the central banks weren't necessarily around in that time, but they did believe in more of a decentralized system for market forces determining things that we've just mentioned. Now, it's very important to realize that both the classical and the Austrian school of economics, they value economic supply slightly more than economic demand. What does that mean? Is that they believe if you have a stable currency is only inflating, say, at just 1 or 2% a year. Now, this is hypothetical. We're just going to run through a thought experiment. But the production of your GDP is increasing at 4 or 5%. Therefore, your actual production, you're more productive in terms of producing goods and services, the supply of goods and services, than the demand, i.e., the currency for those goods and services. And this is where we get into talks about deflation and we get into talks about prices falling as incomes rise or the actual goods and services produced increases, because it's kind of the opposite effect of what we have now. At the moment, we have demand or inflation increasing faster than what the production of goods and services are. But this is almost a reverse idea that if you have a stable money supply, you have maybe inflation at 0%, 1%, 2% with a backed currency, roughly speaking, but you're producing goods and services at 4 or 5% per year, then you've got more overall supply of goods or services in the economy. Therefore, prices hypothetically should fall. Now, again, this is just a school of thought. I'm not saying I'm right or wrong, or that the Austrians or the classicals are right or wrong. I'm just merely putting forward some ideas that may be useful to moving the conversation forward. Now we're going to look at the monetaristic view of economics, or widely known as Milton Friedman's sort of school of thought. Milton Friedman was very critical of central banks in that he believed there was a role for central banks, but they should only determine the money supply. They shouldn't determine the interest rates or central planning or stay out of fiscal policy. They should only be determining the money supply as stable and good for the economy in the sense that it increases with the production of GDP and is there for liquidity to be injected into the markets when needed. But he believed in that was the only role for a central bank. Milton Friedman and the monetarists also believed in a decentralized rate of interest, which is similar to the Austrians and the classicals. They believed there was no need for a centralized planner like a central bank to determine the rate of interest, and that interest rates could be set by markets. They also believed in a stable money supply that could increase with the production of a country's GDP. Now, to finish off, guys, I'm not saying that these are the be-all, end-all solutions to our economic problems, but I'm really just wanting to shift the conversation forward, not just focusing on Keynesian economics, but also adding in these school of thoughts that could potentially help us in the long run around how we can move our society forward, the economy forward, and our monetary policy forward in a better way that is better for everybody as a whole society. And guys, I certainly do not have all these solutions. I'm just hoping to provide some brief ideas around other schools and how we can take their ideas and put them into our current monetary system. What is the role for a central bank in our society, if any? How are interest rates going to be set in the future moving forward? Should we have a stable, a fiat, a commodity-backed currency, or is it more complicated than that? I'm not sure. And how should we manage the money supply moving forward to lead to better outcomes in the world? I'll leave it there for now, guys, and we'll carry on the conversation with some basic critiques of these school of thoughts in the future, just to keep things neutral and to allow the conversation to move on forward. Awesome.